Jerome Powell says do not expect him to be as aggressive as Wall Street would like when it comes to him cutting interest rates. Just yesterday, Jerome Powell, who is the chairman of the Federal Reserve Bank, gave a talk where he said the most recent interest rate cut that the Federal Reserve Bank did, where they cut interest rates by 0.5%, should not serve as an indication as what might be coming in the future, aka expect probably smaller interest rate cuts ahead. So what I want to do in this video is I want to discuss what Jerome Powell said when it comes to interest rate cuts. Then I want to go over what's going on in the car market right now when it comes to interest rates. And then I want to go over what's happening in the housing market and the mortgage market, because we just got some new interesting news on that as well. So let me break this down, starting with what Jerome Powell said. What he said is, quote, "The risks are two-sided." And by risks, he's talking about cutting interest rates. "And we will continue to make our decisions meeting by meeting, because this is not a committee that feels like it's in a hurry to cut rates quickly." What he's talking about is right now, the Federal Reserve Bank is cutting interest rates as a way to stimulate the economy. Between 2022 through 2023, the Federal Reserve Bank was raising interest rates as a way to fight inflation. Now they're saying that inflation is no longer an issue and their goal is to stimulate the job market. But the question that everybody on Wall Street has is, how aggressive is Jerome Powell and the Federal Reserve Bank going to be when it comes to cutting interest rates? And yesterday, the Federal Reserve Bank essentially said, don't expect them to be overly aggressive. What he says is, quote, "If the economy performs as expected, that would mean to cut interest rates by another 50 basis points by the end of the year." In other words, if the economy does what the Federal Reserve Bank expects, you can expect another 0.5 percentage point of interest rates being cut throughout the year. But it might not happen through one meeting, it might happen to multiple meetings, which means we might see two 0.25% interest rate cuts throughout the year. So not as aggressive as Wall Street originally expected, and that created a big shakeup in the market. If you were watching the markets yesterday, or if you saw what we published in Market Briefs today, as soon as Jerome Powell started talking and he said he's not going to be as aggressive with the interest rate cuts, markets went like this. And then by the time he finished talking, the markets kind of went back up to over here. It was a very volatile day based off of what Jerome Powell was saying, which is very fun here in the office, but not very exciting if you are a trader. And this is where Jerome Powell says that the labor market is, quote, "solid, although it has, quote, clearly cooled over the last year." And so what Jerome Powell is working on now is how to stabilize the job market, how to stabilize unemployment, and how to stabilize the economy, because he believes that we are now on a path to stabilize inflation towards 2%. Remember, the Federal Reserve Bank wants 2% inflation. We're not at 2% inflation, but they say that we are on target to see this 2% inflation, which gives them now the power, or what they believe the authority, to now cut interest rates to stimulate the economy, and they're hoping that this will not make the inflation problem worse. Now, of course, we broke all of this down in Market Briefs, which is my free financial newsletter, where every day my team is breaking down what's happening in things like the economy, the stock market, the housing market, the crypto market, and the global economy into a fun, witty, and easy to read newsletter. So if you're an investor and you want to stay up to date on what's happening, Market Briefs is super easy to read and it's free. So if you have not joined Market Briefs yet, I got the link to how you can join down in the description below. And this is where Jerome Powell said that we do not believe that we need to see further cooling in the labor market conditions to achieve 2% inflation. In other words, he believes now that the job market is as weak as it needs to be. We don't need to see higher unemployment to get us to the 2% inflation, which opens up a couple questions that you might be wondering. Why does Jerome Powell and the Federal Reserve Bank want to see a weaker job market in order to cool down inflation? Because, well, the Federal Reserve Bank has been saying now for a number of years that they want to see the job market cool. And the reason why they wanted to see the job market cool, aka higher unemployment, is because if less people have jobs, that means less people have the ability to spend. And if less people have the ability to spend, less people are buying stuff, which gives less power to businesses to continue raising prices. That was the hopes by the Federal Reserve Bank, and now they're saying that because unemployment has come up to around the 4.2 to 4.3%, we were before at the 3.5% number, now that unemployment has come up, we now have the tools to bring inflation down, and they don't need unemployment to go up any higher from here. And so because unemployment is where it is, they believe that the job market is cool enough to bring inflation down to 2%. This is what Jerome Powell is saying. But then he says that the big driver of inflation today is still housing, which needs work. What he said is housing services inflation continue to decline, but sluggishly, meaning the rate of inflation on the housing market, rental prices, housing prices are still high, but it's lower than where we used to be. The growth rate in rents charged to new tenants remains low, and as long as that remains the case, the housing inflation will continue to decline, and broader economic conditions also set the table for further disinflation, aka because the economy is cooling down, he expects inflation in the housing market to also cool down, which is an interesting thing to say when you take a look at what has been happening in the mortgage market over the last number of weeks. So I just pulled the data for mortgage applications and refinancing applications. And what we have seen is now as interest rates have been falling and mortgage rates have been falling, what we have seen is that mortgage applications have increased 11% compared to the previous week. And refinance applications have jumped up 20% from 1 week ago, and they're up 175% from 1 year ago. And mortgage applications are now at the highest levels since July of 2022. So the reason why I bring these two things together is because Jerome Powell is saying that a big reason why the inflation numbers are still high, the CPI numbers are still high, has to do with the housing inflation. And as long as the economy continues down the path that it is, which it seems like what he's talking about is broader economic conditions set the table for further disinflation, which sounds to me like a cool down in the economy. If that happens, less people would be willing to buy homes, which would then reduce the growth in home prices. However, because interest rates are being cut and mortgage rates are falling, mortgage applications are still rising. So we'll see where this goes, because I think this is going to be very interesting, because if we continue to see more interest rate cuts and more drops in mortgage rates, the question is that going to drive more people to want to buy a home because mortgage rates are cheaper? Or is a slowing economy going to balance that out and say, hey, mortgage rates are cheaper, but people can't afford to buy a home, so people are not buying homes? This is where Jerome Powell is saying that the changing in the economy is going to drive less people to buy homes, even if mortgage rates fall. So we'll see where that goes. Of course, I'll be keeping you posted in market briefs. But the last thing that I want to talk about in this video has to do with the car market, because I pulled up some data from Cox Automotive, which was recently published. And what they said is, although we're seeing a drop in interest rates by the Federal Reserve Bank, car loan rates are still very high. If you want to go out and buy a new car, the average interest rate on a new car loan is 9.61%. And the average interest rate on a used car loan or truck is right around 14%, which means, hey, interest rates are falling, but the people that wanted to go out and buy cars are still paying these higher interest rates. Now, this is not financial advice because, number one, I'm just a random guy on YouTube. I'm not a financial advisor. Investing has risks. You're never guaranteed to make money when you invest. In fact, you will lose money at some point, so never blindly trust a random guy on YouTube. But the second part to this is, why are people paying so much money to finance cars during a time where we're seeing concerns in the economy and the job market? And we have a record number of Americans that are paying over $1,000 a month on their car payment. Now, the reason why people are paying so much money on their car payment is because, number one, the prices of cars have gone up over the last 5 years, although we have seen a cooling in that car price growth over the last 12 months. Car prices today are still a lot more expensive than what they were 5 years ago. Number two, people are now financing these cars with higher interest rates, which means if you want to go out and buy an Escalade and you don't have the cash to buy it, that many times people are paying these crazy interest rates, and now they're paying $1,000 a month to finance their Escalade, and that does not include your premium gas, that does not include your expensive insurance, that does not include the expensive maintenance costs. And the concern here is how many people are driving cars that they cannot afford? Because that's a lot of money to be dishing out on cars. And if you go stand out on the street, you see a lot of people driving around in these brand new Escalades, which has to have you wonder. Now, of course, I don't know what's happening in people's personal financial lives, but this is where I like to say, drive a car that you can afford with cash. Do not finance it. Why? Because when you pay interest on these cars, you're doing a double or triple whammy. What do I mean by that? Car prices fall. As soon as you buy the new Escalade, that Escalade's value is going to be falling. Number two, you're paying interest to drive around in a car that's losing value. And then number three, you're buying something that you can't afford in the first place, which means you're sacrificing the ability to actually invest your money into the stock market or into the real estate market just so you can look rich. And so if you're thinking about buying a car, nice. Buy something that you can afford. And when I say buy something that you can afford, that means buy something that you can afford with cash. That way you don't have to worry about the payments. Because when people talk about what's happening in the interest rate market, what's happening with the federal funds rate or mortgage rates or auto loan rates, these things only apply to people who are using debt. If you're buying a car with cash, it doesn't matter what's going on with interest rates, because now you just got to make sure you can afford the price that you're paying. And it's a very freeing thing to not have to worry about a car payment. Now I get it. If you have to finance an Escalade, going from putting 20% down to putting 100% down is a lot of money difference. And maybe you can't buy the entire Escalade yourself. But maybe that means you go out and you buy a $20,000 Toyota or a $20,000 used BMW with cash. That way you don't have to worry about the payments. Because I want you to be a financially educated and sophisticated investor, which means you have money to invest. Instead of just using your money to make Cadillac rich and BMW rich, use your money to make yourself rich first. Stop paying these crazy interest rates because, man, that is very, very expensive. And with that, I will see you on YouTube tomorrow.